Will interest rates come down in 2023? That's a question I've been asked over and over and over. I'm Mortgage Mandy, I'm a loan officer in Northern California, and today we're going to talk about what causes interest rates to go up and down and whether or not you should wait to buy, and many more topics. Stay tuned. There are a variety of factors as to why interest rates go up and down. For one, inflation, that's the biggest factor. The housing market, whether or not it's a strong housing market. The outlook on the global economy is a big one. So if we're in a pandemic, if there are wars going on, that can really impact interest rates. And then, of course, the trading volume of mortgage bonds. Mortgage bonds are traded globally, and if there is high trading volume, that can impact mortgage rates. If there's low trading volume, that can also impact mortgage rates. Inflation is definitely the most influential. Inflation is, when inflation is higher, that tends to drive up mortgage rates. When inflation is lower, then mortgage rates come down. The prime rate is set by individual banks, and the individual banks set this rate in order to kind of create a base rate for lending, for HELOCs, for credit cards, etc. The Fed funds rate is set by the Fed, and that's generally about 3% lower than the prime rate. And the Fed funds rate is the rate at which banks charge interest, basically overnight, for borrowing between banks. When the Fed raises their rates, it makes it more expensive for banks to borrow money. So they in turn end up raising their rate, and that's why the prime rate increases when the Fed funds rate increases. It's not directly related, and I think that tends to confuse a lot of people, but it is influenced by it. So if it gets more expensive for the bank to borrow, they in turn are going to increase their interest rates because they're going to need to recoup that cost. Right. Obviously, when interest rates increase, it decreases the borrowing power that a home buyer has. For every 2% that an interest rate rises, the mortgage interest rate increases $115 per month per $100,000 borrowed. So obviously, the higher the mortgage payment, the less the borrower is going to qualify for. So there are a few things that I would recommend in order to get the best interest rate, and that would be focusing on your credit score. Credit score is going to be hugely impactful on what interest rate you're given. Additionally, the amount of debt that you have. If you have more debt, your interest rate's going to be a little bit higher, and you're also not going to be able to qualify for certain types of loans. The best loans for the lowest interest rate right now are actually government loans, so like FHA, USDA, VA. And the other benefit to going with a government loan right now is that you can actually get a larger seller credit. When you get a larger seller credit, the seller is not only able to cover your closing costs, but they can buy down your interest rate for you. So you kind of get the advantage of the slower housing market. You have more negotiating power, and you often will get your closing costs covered. Sure, so that's another thing that I think a lot of people don't realize. It's a really common myth. So obviously VA, you do have to be a veteran, but for USDA and FHA, it is not just for first-time home buyers. A lot of people think it is because those two loans are very commonly used by first-time home buyers, but technically you can reuse those loans over and over. The catch is that in most cases, you can't have two of those loans at one time. So if you wanted to, purchase a property and then house hack in the future or something like that, maybe use the FHA loan for your first purchase and then a conventional loan for your second purchase.
Got it.
So if you want to hold on to both houses at the same time.
Right. So you'd have to, if you'd want to continue using that loan, you'd have to sell the home and then
sell or refinance out of it. You can refinance your FHA loan into a conventional loan, and then that frees up your ability. You can use your FHA loan on the next purchase. Every time you use an FHA loan, it's 3.5% down. I know.
That's amazing.
Even with a duplex, triplex, or fourplex. With a triplex and fourplex, there are some other caveats that do go into having an FHA loan. It's called a self-sufficiency test, so the property has to pass that. But for a single-family residence or for a duplex, it's the best option. As long as you live in one of the units. You have to live. It has to be your primary residence for a certain period of time. You can move out of it and keep that FHA loan on it, but you have to intend to live in the home when you purchase it. In my opinion, homebuyers should not wait for rates to go down. And here's why I say that. For one, right now with the higher interest rates, you have a lot more negotiating power. So oftentimes you can get a lower offer accepted. You can also get seller credits incorporated into the transaction. So you may end up again with a lower interest rate or the seller covering your closing costs. And when the interest rates are higher, there's less demand. So you're not competing with as many buyers. However, when we do see rates come down, that will end up in increased demand in the market. And therefore, you're going to be competing with all of those other buyers that were waiting for the same thing. So I don't have a crystal ball. And we obviously could not have predicted big events such as, the pandemic and certain wars and things like that. But in general, the consensus is that June, July-ish is when we're going to start seeing rates come down into the 5s. And if that happens, there are going to be a lot of buyers that are going to come out of the woodworks that have been waiting, because that's a pretty big difference from where we were in the 7% range not too long ago. And when you are competing with other home buyers, that's going to oftentimes mean that you're going to have to write stronger offers, and sometimes you have to give things up. So, you're going to have to not take that seller concession, not take that interest rate buy down, possibly even forego doing some inspections. It gets very competitive when we see rates come down. The best way to prepare for any home buyer, regardless of whatever the market is to make sure that your credit is in check. You want to make sure that you are in a strong position as a buyer. Because if you do find yourself falling in love with the right home and you do end up in a competitive situation, you need to make sure that your financing is strong and secure. So I would definitely focus on credit. I would also focus on working on saving. Right now is a great time to save your tax return if you get one. And I think a lot of people are under the impression that home prices are coming down. And from both a real estate and mortgage perspective, we're just not seeing that. We're seeing certain areas have price reductions because real estate's hyper local, so depending on the market. But overall, nationwide, we had, depending on the report that you read, anywhere between 4 and 10% increase in prices last year. And the consensus is that on average, the nation is going to see another 4% increase this year, even with rates being what they are and inflation being what it is. We were really spoiled over the last few years with interest rates in the 2s and the 3s. And there are no experts that are forecasting rates to come down into that range. So in order to increase your buying power, I would make sure that you negotiate, if you can, a seller credit sooner rather than later while the market's still a little bit slower, because the lower your interest rate that you can buy down with the seller credit, the more increased your buying power will be. For an FHA loan, for example, you can negotiate up to a 6% seller credit. So that means 6% of the sales price can be provided back to you in the form of a credit at closing. So you can use that credit for a variety of things. You can use that credit to cover all your closing costs. You can use that credit to buy down your interest rate either temporarily or permanently. And if you buy it down permanently, that increases your buying power. So you may actually be able to qualify for a little bit more home if you're able to get the seller to agree to provide the full seller credit. So while I don't have a crystal ball, I do follow many different experts that forecast mortgage rates. And the consensus is that we are going to see rates improve as long as inflation continues to come down. If you're interested in learning more, hit that like button and subscribe, and I'll see you in the next one.